All right, why don't we continue with the third panel. You may begin.
Good morning. On behalf of the Concerned Shipper Associations, comprised of the American Chemistry Council, the Fertilizer Institute, the Chlorine Institute, and the National Industrial Transportation League, I want to first thank the Board for initiating this proceeding and scheduling this hearing. As has been the case with our written comments in this proceeding, our testimony today will focus upon the revenue adequacy questions in docket Ex parte 722. Over the course of our testimony, we will address the following questions from the Board's hearing notice. What is the appropriate time period for measuring revenue adequacy, and what is an appropriate definition for a business cycle? Should the Board require a revenue adequate railroad to justify rate increases for complaining shippers, and would this be consistent with the statute and the relevant law? Should a revenue adequate railroad's ability to differentially price be limited for all captive shippers or for a subset most likely to be subject to railroad market power? And is there a way to identify those shippers most likely to be subject to market power, such as RSAM, RVCs, or the maximum markup methodology? Finally, we will discuss the impact of our revenue adequacy proposals on the railroads in light of recent service issues facing the rail industry. As we have watched the rail industry achieve or come close to achieving revenue adequacy through its unprecedented financial success, it is clear that the revenue adequacy goals of the Staggers Act have been or very soon will be met. As the ICC recognized in coal rate guidelines, the achievement of revenue adequacy opens the door for alternative methods for determining whether the rates charged to captive shippers are reasonable because, quote, captive shippers should not be required to continue to pay differentially higher rates than other shippers when some or all of that differential is no longer necessary to ensure a financially sound carrier capable of meeting its current and future service needs. The revenue adequacy constraint, thus, is a long-awaited and economically supportable and judicially supported alternative to standalone cost, or SAC. As demonstrated at the end of yesterday's testimony, SAC has proven to be too costly, too complex, and too lengthy to be of practical use to all but a handful of captive shippers. The entire constrained market pricing construct designed by the ICC and coal rate guidelines was to determine the proper level of differential pricing. None of the 4 rate constraints and guidelines, including revenue adequacy, is predicated upon rate of return or earnings type regulation. The assertions to the contrary in yesterday's railroad testimony are simply an exercise in misdirection. Specifically, coal rate guidelines states that the constraints in CMP represent different means of approaching the same basic issue, i.e. the extent of unattributable cost to be covered through differential pricing and the portion that can be charged to the shipper involved. Moreover, each constraint was designed to approach this question from a different perspective. The ICC again specifically stated that our guidelines offer the flexibility to approach the rate analysis from various perspectives. Number 1, appropriate level and minimum cost of efficient service to captive shippers in the SAC analysis. Number 2, the appropriate level of carrier revenue needs in the revenue adequacy examination. 3, other available means of meeting or eliminating those revenue needs through the scrutiny of the carrier's efficiency, as in the management efficiency constraint. And finally, the phasing constraint, which is the public interest in minimizing economic disruptions. Although SAC and revenue adequacy are both constraints upon differential pricing, they were never intended to operate the same way or to produce the same results. Indeed, in guidelines, the ICC stated that the various constraints contained in CMP may be used individually or in combination to analyze whether the rate at issue is unreasonably high. The overarching objective of the concerned shippers in this proceeding has been to provide the Board with concrete proposals for implementing the revenue adequacy constraint. Our guidelines for developing proposals that we will present today have been to make them practical, cost-effective, economically supportable, and within the existing statutory parameters. Consistent with guidelines, our focus throughout has been on regulating the level of differential pricing, not rate of return or earnings regulations. Through specific examples today, we will illustrate how our proposals could work and prove that they do not constitute rate of return regulation. Specifically, we will show that the parade of horribles posited by yesterday's railroad economic witnesses cannot come to pass because our proposals protect competitive traffic's contribution to revenue adequacy and do not impose an upper limit on railroad earnings. Our testimony will cover 4 principal subjects: the critical role of revenue adequacy in implementing Ramsey pricing principles in coal rate guidelines, the proper time period for measuring revenue adequacy, methods by which the board could implement the revenue adequacy constraint, and the impact of those proposals upon rail service and investment. Although our focus is on Ex parte 722, that should not be construed as disinterest on our part in Ex parte 664. We are very much interested in that proceeding because how the board measures revenue adequacy is a predicate to determining the applicability of whatever methodologies the board eventually adopts for implementing the revenue adequacy constraint. We have deferred to Western Coal Traffic League to argue the issues in Ex parte 664 so that we can devote our resources to developing proposals for properly implementing the revenue adequacy constraint upon rail pricing of captive traffic. We nevertheless desire to express our support for the WCTL petition and the positions that they have advocated in this proceeding, which demonstrate that, if anything, the board's existing measure of revenue adequacy has established a conservatively high bar. The concerned shipper associations are represented today by the 5 witnesses at this table. Together with Paul Donovan, I am counsel to the concerned shipper associations, and we are here to address the legal questions. We are accompanied by 3 economic witnesses. To my left is Dr. Kevin Caves, who will address the role of revenue adequacy in developing more efficient rail pricing, conceptual approaches for applying the revenue adequacy constraint, and the impact of those approaches upon rail investment. To my right is Thomas Crowley, who will provide a practical illustration of how to determine if a rail carrier is revenue adequate for purposes of applying a revenue adequacy constraint. Mr. Crowley also will provide practical illustrations of how to apply the conceptual approaches described by Dr. Caves. To my far right is Jay Roman, who will review key financial metrics for the rail industry to demonstrate why adoption of a revenue adequacy constraint is unlikely to have any impact upon rail service or investment. Because each witness covers multiple interrelated topics, our presentation format today will be a little different from your typical testimony. Instead of going down the table with each witness speaking one at a time, we will have a moderated format that rotates among the witnesses according to the topics at hand. Mr. Donovan and Mr. Roman together will begin this testimony by addressing why revenue adequacy constraint will not impact rail service or investment.
Thank you. I would like to invite the board's attention to page 3 of its order in this proceeding, and I'll just quote that to you. It's very brief. Some comments argue that any proposal that would limit the railroad's return on investment would negatively impact the railroad's ability to invest in their networks and expand capacity. Please discuss the impact of your revenue adequacy proposals on the railroads, again, in light of the recent service issues faced by the industry. I'm going to ask Mr. Roman to present information to you that will demonstrate, I think, to your satisfaction, that the railroad industry is not facing service problems. The railroad industry is creating service problems. With that, Jay.
Okay, thanks, Paul. My name's Jay Roman. Pleasure to be with you this afternoon. As Mr. Donovan said, I'm going to be going over both the operational and commercial results of the 4 major Class 1 railroads. We're going to do this for the last 10 years, starting in 2005 and ending in 2014. And whenever you're looking at the railroads, one of the first things you want to do is start out with carloads. The illustration on the screen has annual carloads each year between 2005 and 2014. And you see that the carloads varied quite a bit over this time frame, but they ended up pretty much where they began. In the year of 2005, we were looking at 34.7 million carloads on the 4 major Class I railroads. The only year where we exceeded that number of carloads was 2006. After 2006, carloads plummeted. With the recessionary years of 2008 and 2009, they hit a low point. And then after 2009, carloads were increasing each year. But in 2014, we still have 34.5 million carloads, which is virtually almost the same as it was in 2005. So when you're looking at this carload information, based upon all the money that the railroads are saying they're putting into the system, you would expect that service has really improved, because the carloads are the same in 2014 as they are in 2005. If lots of money is invested in the system, you would expect service to be a lot better. But unfortunately, that's not the case. The service metrics that we're looking at, first off, we're looking at dwell time. Between 2005 and 2014, dwell time is the amount of time it takes a car to get out of the yard. And dwell time increased by 6.1%. Okay, that is not a positive for service. Train speed between 2005 and 14 increased slightly, and my chair has increased slightly here. Where are we? Well, I'm falling down.
One of our trick chairs.
Well, maybe I have this. Okay. Train speed has increased slightly over this time frame, but it's not too different from what it was in 2005. Total carloads, which we just looked at on the previous illustration, is down. So when we're looking at operation results of the railroads, they haven't really improved over the last 10 years. Now, what this is demonstrating is that shippers are frequently complaining about what is happening with their service, and these metrics give you an example of why. Based upon the rate increases the railroads have had over this time, service really hasn't improved. And you're faced with a dichotomy at the board. You have the railroads coming in and they're saying, we're investing all this money in our system, and you have the shippers which are saying, gee, we're not really receiving the benefits of that. We don't see our service improving, and some shippers are complaining that their service is going down. So to try to get to the bottom of why this dichotomy exists between what the railroads are saying and what the shippers say they're actually getting from the railroads, we looked at what has happened to the change in the railroads' operating profits. We wanted to see where those operating profits were going to. And for that, we looked at the primary destination for operating profits, which was capital expenditures and payout to stockholders. And first off, we're looking at the year of 2005. Payout to stockholders includes 3 things. It includes dividends, it includes stock repurchases, and when we get to 2010 and thereafter, it includes the BN's disbursement to the parent company. So if we look at 2005, we see that payout to stockholders was $1.67 billion. Capital expenditures were a little over $6 billion. It's kind of a 22% versus 78% split between payout to stockholders and capital expenditures. When we then look at the second pie on the chart on the right, that is for the year of 2014, and we have a very different picture. And one of the reasons we have a different picture is the railroads made a lot of additional profit. Between 2005 and 2014, railroads' operating revenue increased about 64%, while their operating expenses increased about 38%. We're dealing with a 26% difference. So even though the carloads the railroads moved were pretty much the same in 2005 versus 14, 26% additional revenue generates a lot of additional profit. And there was a lot more that was spent by the railroads on both capital expenditures and payout to stockholders. The pie for payout to stockholders increases dramatically more in 2014 from where it was in 2005. And the reason for that is there was about a 530% increase in payout to stockholders over this time frame. So it caused payout to stockholders to represent a much larger portion of the pie between capital expenditures and what went to the stockholders. Now, capital expenditures also increased over this time. They went from $6 billion in 2005 to a little over $14 billion in 2014. But what this is demonstrating is that the money that has been going to the stockholders is actually increasing dollar values more than capital expenditures. The increase in payout to stockholders was about $8.8 billion here, where capital expenditures were just about at $8 billion. Well, this is just looking at one slice of time between 2005 and 2014. So we also looked at this over a longer time period. And this illustration is showing what happened to payout to stockholders versus capital expenditures over the time period of 2005 to 2009 in the left pie. And then the more recent time frame is what happened in the 2010 to 2014 time frame. And what you find that in 2005 to 2009, there were $61.5 billion that went to one of these two categories. And there was about, payout to stockholders was about 35% of the pie during this time frame, and the capital expenditures were about 65%. When we go out to the more current time frame, 2010 to 2014, our pie looks very different, and we're getting pretty close to a 50-50 split. And the reason for that is there was much more money that was put into both of these categories, $103.9 billion. But in the payout to stockholders, it increased by $25.5 billion, while capital expenditures increased by $16.9 billion. So what this information is demonstrating is that stockholders made out very well from the increase in rail profits. And I'll demonstrate that on the next illustration. This bar chart is showing, the second bar down is showing the increase in operating profit between 2005 and 2014. Operating profit increased 173%. Well, with this increase in profit, railroads were able to give a 530% increase in payout to stockholders. Both of these things caused a dramatic increase in the value of railroad stock. And the four publicly traded railroads, UP, NS, and CSX, the average price of their stock between 2005 and 2014 increased about 345%. Now, in my written testimony, I have a number in there that the railroad stock price only increased 168%, and that's because I made an error. But the reason for the error is pretty important. Because of the big increase in railroad profits, their stock price was soaring. It was going up rapidly, and there were a number of different stock splits that the railroads initiated. In my earlier number, I didn't catch all of the stock splits of the railroad. When you consider all the times that the railroad stock split over this time frame, the increase was 345% in the value of their stock. So shareholders have obviously benefited greatly from increased rail profit. The rest of the measures on this bar chart have to do with railroad operations. The next two bars down, miles of owned track and revenue ton miles per owned mile of track, these are a little bit different than other things we're looking at. These are AAR numbers. These are not numbers for just the four major railroads. The Association of American Railroads only puts this data out for all the Class I railroads. And we didn't have this data available for 2014, so these percent changes stopped in 2013, but they're pretty instructive. When we look at miles of owned track, between 2005 and the 2013 timeframe, it was down 1.4%. So there's less track that the railroads own. When we look at the revenue ton miles per owned mile of track, it shows that there's greater congestion because there's more revenue ton miles going across the track they own, because that's increased 4.1%. The other bars on this chart are things that I've already discussed. Average dwell time has increased 6.2%, which means the cars are staying in yards longer. Average train speed is pretty similar in 2015 to what it was, 2014 to what it was in 2005. And carloads are pretty much the same. What this is demonstrating that the increase in rail profit has not improved operations for shippers. Now, when we look at this data, it needs to be considered that there are two different types of capital expenditures that the railroads make. One type of capital expenditure is to maintain the existing infrastructure of the system. There is a different type of capital expenditure that can be made, which is to improve capacity on the system. What these numbers demonstrate is that the capital expenditures the railroads are making are more for capital expenditures to maintain the existing infrastructure of the system, because service hadn't improved over this time frame, even though the number of carloads that the railroads move is virtually the same in both 2005 and 2014. Now, I'd like to conclude my testimony here with just saying that the purpose of doing this analysis was try to explain the dichotomy between what you're hearing from railroads versus what you're hearing from shippers. And what the results of the analysis show is that rate increases are not necessarily the answer to getting better service. And what the analysis shows is that in order for you to properly control service, it will be very difficult without being able to institute some type of control over how much of the increase in the railroad's profits caused by rate increases are put back into the rail system. And that concludes my testimony.
Thank you. Dr. Caves will now address the role of revenue adequacy in Ramsey pricing and explain why revenue adequacy constraint provides a more efficient pricing structure than standalone costs for regulating rail rates.
Thank you, and good afternoon to everybody. I'll start out by talking about standalone cost. Standalone cost is the hypothetical cost to a railroad of providing service to only a subset of its full network. By definition, a standalone cost provider is less efficient than the incumbent provider because it has fewer efficiencies available to it in terms of scale and scope economies. The first problem with trying to apply standalone cost regulation to the rail industry is that it's actually designed to solve a problem that doesn't exist in the rail industry in the first place. In particular, and this slide is for later actually, in particular, the standalone cost framework was developed for use in a fully regulated monopoly in which regulators set all the prices that the fully regulated monopoly is allowed to charge. Under these specialized conditions, standalone cost will prevent cross-subsidization among different groups of customers. That is the purpose for which the standalone cost test was designed. Of course, that simply doesn't apply here. The majority of rates, as we all know, are fully deregulated. You don't have to take my word for it. The original author of the SAC test, Jerry Fallhaber, has already submitted a verified statement in which he has debunked the railroad's claims that the standalone cost test is well designed for the rail industry. But just to reiterate, because I've heard these claims repeated by the railroads yesterday, I'll just read a few key passages from Professor Fallhaber's verified statement. He begins on page 1 by repeating some of the rather grandiose claims that have been made about the standalone cost test by the railroads, such as the standalone cost test rests on a sound economic foundation. The standalone cost test is the most accurate procedure for determining rail rates. The standalone cost test is widely and consistently recognized by economists as the gold standard, et cetera, et cetera. Professor Fallhaber's response to this is, quote, as the original author of standalone cost, I would be quite flattered by all this if any of it were true. And he goes on to explain why it's not and why it's not accurate. He also goes on to explain that the standalone cost framework, quote, simply doesn't fit the STB regulated firms. It is not even close. This provides no economic justification for imposing standalone cost regulation. None, end quote. That's the first problem with applying standalone cost regulation. The second problem with applying it to the rail industry is it's not designed to prevent prices to captive shippers from rising above competitive levels. There is nothing in the SAC standard that will prevent prices to captive shippers from rising well above competitive levels right up to the fully monopolistic pricing level. The SAC standard, in fact, focuses the regulator on the inefficiently high cost of a hypothetical network and inappropriately rewards railroads for their incumbent position by linking their prices to those of a less efficient hypothetical rival. So now I'd like to talk about the alternative, which is, of course, a revenue adequacy standard. The first thing to clarify about revenue adequacy is that under this standard, by definition, the railroads would always be able to cover all of their costs, all their fixed costs, all their variable costs, and all of their costs of attracting capital. By definition, that will be true. And this may well require, this will in fact tend to require that the railroad exercise some degree of market power with respect to its captive shippers. However, after revenue adequacy is achieved, the railroad should also face some constraint on the exercise of market power with respect to its captive shippers. Why is this? Well, it's just basic economics. An unconstrained monopoly pricing causes economic efficiency or deadweight loss, and you will find this in any Econ 101 textbook, I can guarantee you. This brings us to Ramsey pricing principles, which are very closely related to revenue adequacy. According to Ramsey pricing principles, the objective of an economically efficient pricing structure should be to minimize the deadweight loss of monopoly pricing, subject to the constraint that the railroad must earn sufficient returns to cover all of its costs, including the cost of attracting sufficient capital. In other words, the Ramsey pricing framework is an exercise in constrained optimization, and revenue adequacy defines the constraint to the Ramsey problem. And I'll try to go over this in a little more detail and illustrate it in the next slide. Sorry, the previous slide. Yes. So the idea motivating Ramsey pricing is very simple. Economic efficiency, according to very basic principles in economics, is promoted, all else equal, by setting price equal to marginal cost. However, when you have an industry with economies of scale and high fixed costs, as you do in the railroad industry, marginal costs will tend to lie below average cost, and that means strict marginal cost pricing is not feasible. Any entity that attempted to set all its prices equal to its marginal costs would go out of business. So how do you solve this dilemma? Well, there's the profit maximizing solution, which is simple. You set price as high as possible above marginal costs and just charge whatever the market will bear. The problem with this is what we've already mentioned earlier. If you have a monopoly exercising market power, you're going to get monopoly pricing and you're going to get deadweight loss, and that's economically inefficient. So Ramsey pricing principles provide a better, more efficient solution to the problem. And it's a very intuitive solution. The idea is, yes, go ahead and set price above marginal cost. That has to be true, but only by enough to cover all of the costs, all the fixed costs, all the variable costs, all of the necessary investment returns. So again, it's an exercise in constrained optimization in which the idea is to move price as close to marginal cost as possible without violating the revenue adequacy constraint. However, as long as that constraint is satisfied, as long as the railroad is earning sufficient returns, any rate adjustment closing the gap between price and marginal cost is economically efficient. That's what Ramsey pricing tells us. Any adjustment, even if the full Ramsey optimum is never achieved. So suppose we have a shipment and the exact Ramsey price is $100, and we have a monopolistic railroad that's charging $1,000. If we move that rate from $1,000 to $500, that would still involve a very substantial improvement in economic efficiency, even if we never get it down to 100. So in conclusion, Ramsey pricing principles imply a substantial scope for efficiency improvement in railroad rate structures with respect to captive shippers, and these improvements can be realized by lowering prices below the levels implied by SAC and closer to the Ramsey levels, even if the exact Ramsey price is never actually reached.
This brings us to the question of how do you actually implement the revenue adequacy constraint in practice? Dr. Caves, Mr. Crowley, and I have given extensive consideration to how the board might apply the revenue adequacy constraint in a manner that is practical, cost-effective, economically supportable, and consistent with the statute. The first step in developing any methodology for implementing the revenue adequacy constraint is to identify the proper time period for assessing the revenue adequacy of a rail carrier, which is a question that the board has posed in its hearing notice. Dr. Caves will address this predicate question And he will be followed by Mr. Crowley, who will illustrate how to determine the extent to which a railroad is revenue adequate, consistent with Dr. Cave's testimony.
Thank you. The ICC has previously suggested measuring revenue adequacy over the course of a business cycle, and that is, in fact, an economically valid and supportable approach, essentially because it adopts a reasonable investor perspective. Investors care about future returns, and they face the problem of trying to gauge future performance based on past performance. Of course, the economy is pro-cyclical. It goes through business cycles. It goes through ups and downs. So the railroad's profits at the peak of the business cycle are going to tend to overpredict its future returns, and their profits at the trough of the business cycle will tend to underpredict future returns, obviously. So you don't want to pick one single year if you're an investor trying to figure out whether to invest in the railroad. So if we just take the average performance over the course of a business cycle, that will give a better, more reasonable estimate of expected future returns. Over the post-war period, if you looked at the NBER website, the NBER is the official body that dates business cycles. The average business cycle has lasted for about 69 months, or about 6 years. So this is a reasonable time frame for measuring revenue adequacy. Notably, the most recent U.S. business cycle includes the Great Recession of 2007 through 2009. This is universally recognized among economists as the most severe economic downturn in the post-war period. In other words, the most severe recession we've had since the Great Depression. It's been more severe in terms of duration and in terms of losses in employment and in output. I bring this up because the railroad's robust financial performance during and since the Great Recession can and should be seen as powerful evidence of their long-term financial viability and of their ability to compete with other industries for capital in the equity markets. In fact, if we were to just look at the railroad's returns since the end of the recession, we would find that railroad stocks have gone up since mid-2009 by about 239%. The Dow Jones Industrial Average has gone up by less than half that amount, 110%. The S&P has gone up by 125%. Trucking stocks have only gone up by 76%. Yet, according to the railroads, they can't even earn enough to cover their cost of capital, and they're a bad investment. So by that logic, I think they would have advised you not to buy their stock in 2009. I think you should have bought it personally. And another point we'll get into later is if the railroads are not in fact earning enough to cover their cost of capital, how in fact have they made the investments that they've rightly been proud of and have been reporting to you. For example, since the end of the Great Recession, they have invested $168 billion. In the past 10 years, they've invested $244 billion, and in the past 20 years, since 1995, they've invested $394 billion. Now, over the vast majority of this time period, by the board's own metrics, they were revenue inadequate. And what that tells us is that the revenue adequacy measures that we're using are a very conservative measure that understates the railroad's true ability to attract capital. And I think it's important to keep that in mind.
Using actual UP data as the example, plus the 6-year business cycle that Dr. Caves was talking about, I demonstrate in this analysis how to measure the shortfalls and surpluses related to revenue adequacy on a year-by-year basis. Column 1 identifies each of the years in the analysis. Column 2 identifies the STB's determination of the railroad industry cost of capital for each of the 6 years in the business cycle. Column 3 shows the UP's tax-adjusted revenue shortfalls and surpluses by year over the same 6 years as determined by the STB in its calculation of UP's revenue shortfall allocation method, or RSAM ratios. Specifically, column 3 shows that UP has generated tax-adjusted surplus every year except for 2009, when the country experienced the largest economic downturn in the post-World War II period. Column 4 calculates the value of each year's surplus or shortfall in 2014 dollars using the railroad cost of capital appearing in column 2 to calculate each value. Line 7, column 4, shows the sum of the surpluses and shortfalls over the 6-year business cycle, and line 8, column 4, shows the average surplus, which we'll use in later slides.
So once a rail carrier is determined to be revenue adequate, as this example demonstrates for Union Pacific over the most recent 6-year period available based on the board's revenue adequacy determinations, the revenue adequacy constraint can then be applied to determine the reasonableness of the challenged rate. Dr. Caves has identified 2 potential approaches for implementing the revenue adequacy constraint, which he calls the yardstick approach and the rebate approach. Dr. Caves will first discuss the conceptual underpinnings and practical application of the yardstick approach, and then we'll turn to the rebate approach after that.
Thank you. So all right, we'll stay there for now. So the yardstick approach, the basic idea is to use statistical methods to predict the rates that captive shippers would pay under more competitive conditions. So in essence, you take a sample of comparable competitive rates and you compare it to what shippers are paying and see if there's a significant difference. This appeared to be what some of the railroad's own economists were endorsing during their testimony yesterday. Specifically, I think it was Professor Kalt. In any case, the idea would be to, when you're drawing the sample of competitive shipments, to obtain the rates of the competitive shipments, and then to obtain relevant characteristics of these competitive shipments, such as the commodity type, distance, the distance of the shipment, the size of the shipment, cost variables from IRCs perhaps that influence the cost of making the shipment, and so forth. Once we have this variable, we can build a model that quantifies the relationship between the characteristics of the shipment on the one hand and the actual rates paid on the other. Once the model has been developed, shippers in captive markets could, in effect, take the characteristics of their shipments, plug them into the model, and see what the comparable competitive rate is for their shipments, perhaps through an interactive website. If the shipper's actual rate sufficiently exceeds the predictive competitive rate, then the shipper would have a basis for relief. Of course, if the shippers were already paying something close to the predicted competitive rate, then they would have no basis. The TRB has already endorsed this approach and constructed a prototype model that does exactly this, and you can read about it in their full report. They used the carload Weibo sample to do so. I will give a highly simplified example in what follows that sort of follows the broad contours of the TRB while hopefully giving a more intuitive explanation of how the benchmark approach would work. And when I say benchmark, we're going to use benchmark and yardstick interchangeably here. Okay. So here we have a very simplified version of what the model would look like for illustrative purposes. On the horizontal axis, we have the distance of the shipment measured in miles. On the vertical axis, we have the rate of the shipment measured in cents per ton mile. And you can see we have a scattering of blue diamonds that represent a sample of competitive rates. So this would be the blue diamonds are our benchmark sample. And according to this simple model, the actual rate is a linear function of the distance of the shipment. You can see there's a straight line going through the blue dots. In particular, the slope of the line is negative because we would expect that for longer distances, shippers would tend to pay lower rates per ton mile. And in fact, that's what the TRB itself has found in its own work. So once you have the sample and once you've estimated the model, in this case just a straight line, the potentially captive shippers can compare their rates. So I have 3 hypothetical potentially captive shippers here, shipper A, shipper B, and shipper C, all paying potentially anti-competitive rates. So let's perform the comparison first for shipper A. You can see that here. Shipper A would first, well, obviously it would know its actual rate. It could just read over to the vertical axis, 14 cents per ton mile. And that's being shipped over a distance, if you read it down to the horizontal axis, over roughly 700 miles. And according to the benchmark model, comparable shippers shipping over a distance of 700 miles are paying a competitive rate of approximately 7 cents per ton mile. So shipper A appears to be paying about twice as much as what comparable competitive shippers are paying. Same exercise would go through for shipper B. Shipper B is shipping over a longer distance, about 1,000 miles. Its actual rate is 10 cents per ton mile. And comparable competitive shippers are paying about 6 cents per ton mile for shipping over the same distance. And once again, for shipper C, it's the same exercise, 9 cents per ton mile being the actual rate, and 4 cents per ton mile being the competitive benchmark rate. The other thing to note about shipper C is you can see clearly in the model that there are competitive benchmark shipments that are paying rates higher than what C is paying, right? So if you look over to the left-hand side, those two blue diamonds there are both above the red dotted line. So those are competitive shippers who are paying more than 10 cents per ton mile, whereas shipper C is paying over 9 cents per ton mile. But of course, they're shipping over a much shorter distance, so you'd expect them to be paying a higher rate. So now that we've done this comparison for shippers A, B, and C, we can compute a very simple statistic, which is simply for each shipper the ratio of the rate it actually pays to the rate it's predicted to pay under more competitive conditions. So for shipper A, recall that they were paying 14 cents per ton mile. Their predicted competitive rate was 7 cents per ton mile. You divide one by the other, and you get a ratio of 2. So they're paying twice as much as what the competitive benchmark says. Shipper B, on the other hand, is only paying 1.67 times as much as the competitive benchmark. Shipper C is paying 2.25 times as much. So this ratio is useful because it tells us which shippers are facing the steepest overcharges relative to the competitive benchmark. The next step in this method is to select an allowable differential, a maximum value for R that we're going to allow. And this can be calibrated to protect revenue adequacy. When we set the R max, when we set the allowable differential, it tells us two things. First, it tells us how many shippers are going to get relief. And second, it tells us how much relief they're going to get, assuming that they qualify. So, for example, it's very intuitive. If we started out with a low level of R max, such as 1.6, well, it's clear that all three of these shippers would qualify for at least some degree of rate relief because they're all starting out with a ratio above 1.6. In particular, shipper B would qualify for a modest amount of relief because it would only take a small adjustment in its rate to put it right back down to 1.6. It's starting out at 1.67. Shipper C would qualify for a lot more relief because it's starting out at 2.25. Alternatively, we could select an R max equal to 1.9. In this case, only 2 out of the 3 shippers would qualify for any rate relief at all because shipper B's ratio is already is below 1.9. Shippers A and C would both qualify for rate relief, although they would qualify for less rate relief than they would have qualified for if the R max were 1.6 instead of 1.9. And the same exercise goes through for an R max of 2.1. In that case, only shipper C qualifies for rate relief, and it qualifies for less rate relief than it would have qualified for under the other 2 scenarios. The point of this is, whatever the results of the regression model ultimately adopted by the STB, and we don't know what those are going to be, it would be a much more complicated model. RMAX could always be calibrated to target rate relief to a fixed percentage of potentially captive shippers. As the TRB observed when it endorsed the benchmark method, quote, should not threaten revenue adequacy because regulators would be able to set the strictness of the screen, that is, the amount by which a rate can exceed its predicted competitive level before being subject to a challenge, end quote. One approach that the STB could think about taking would be setting a relatively high, so relatively conservative value of R max initially, engaging the effect, if any, of this rate relief on revenue adequacy, and then gradually relaxing it over time. In conclusion, what the yardstick approach accomplishes is to A, preserve differential pricing to captive shippers, because you'll notice no matter where we set our max, there is still differential pricing literally built into the system. Everyone is going to be paying more than what a comparable competitive shipper pays for any R greater than 1. So we preserve differential pricing, and we also target rate relief to the shippers that face the steepest overcharges relative to competitive levels. Because again, no matter where we pick our max, the shippers that are facing the steepest overcharges are the most likely to qualify for relief and are going to qualify for a higher level of relief than other shippers. And now I'll turn it back to Mr. Moreno.
We believe that the yardstick approach is probably the preferred approach that we are going to present this afternoon. But the key to the yardstick approach is to be able to identify railed shipments that face meaningful competition, because those are the benchmarks in which we're inputting into this regression analysis. That's probably also the most challenging aspect of implementing this approach. The TRB has identified certain fields in the costed waybill sample that it was that are indicators of meaningful competition. And they also link some of those fields to outside data sources to bring in additional information. But that's probably only a start. More information is likely to be useful and necessary to implement this approach. The board itself could expand the data needed in the costed waybill sample to capture some of the additional fields or information that would be needed to implement this approach. It also could be appropriate for the STB to conduct studies through formal proceedings, somewhat of a blend of a market dominance determination and a commodity exemption proceeding, for example, to identify the attributes of effective competition for specific types of commodities that could be applied in an objective manner to the costed waybill sample movements as either captive or competitive, to give you a pretty solid determination of what those are. The yardstick approach, although it would require substantial initial investment of time and resources by the board and its stakeholders, the process would be relatively easy to implement and update thereafter. An alternative to the yardstick approach that could be implemented more immediately is the rebate approach that you've heard so much maligned yesterday. Dr. Caves will begin by addressing the conceptual underpinnings of the rebate approach, and Mr. Crowley will then illustrate two potential ways to implement the rebate approach that are based upon methodologies already familiar to the board and upheld by the courts. Mr. Crowley will refer to these two rebate alternatives as the proportional reduction method or the 3M or maximum markup method.
Thank you. The rebate approach, the objective of the rebate approach is to combine the efficiency properties of differential pricing with some limitation on the railroad's ability to exploit its monopoly position vis-a-vis captive shippers. The idea is, of the rebate approach, is to take a portion of the railroad's surplus revenue, only a portion, and put it in a pool that is potentially subject to rebating to captive shippers in the form of lower rates. So just to clarify, by surplus revenue, we mean revenue above and beyond what the railroad requires to remain revenue adequate. So the rebate approach takes only a portion of that surplus and protects the contribution made to surplus revenue by any presumptively competitive traffic. There are two approaches, two variations that we'll talk about as to how the rebate approach could be implemented. The first we'll call the proportionality approach. This one adheres most closely to Ramsey principles in the sense that shippers with lower demand elasticities should pay higher rates according to Ramsey principles. So the proportionality approach attempts to adhere to that. The maximum markup method, on the other hand, targets shippers paying the highest rates. And this is more consistent with what I understand to be the long canon factors in the statute. At the same time, the maximum markup method is still very much consistent with Ramsey pricing principles because, as we saw earlier, any adjustment of price towards marginal cost will increase the efficiency of the pricing system according to Ramsey pricing. And with that, I'll turn it over to Mr. Crowley.
Continuing with the fact that actual data shows that UP is revenue adequate over the 6-year business cycle from 2009 through 2014, I developed the example on the screen to show how the rate reduction would be applied to captive traffic following the proportional reduction approach. The example begins with actual UP 2014 revenues on line 1. The actual average UP revenue surplus over the 6-year business cycle that I discussed earlier is shown on line 2. Line 3 identifies the percent of aggregate excess surpluses provided by captive shippers. This allocation to captive shippers is calculated as follows. Using the traffic and revenue data from either the railroad's records or the STB's confidential waybill sample, each movement will be arrayed from highest to lowest based on its RVC ratio. Using 180% RVC as the demarcation point, all movements with RVC ratios less than 180% would be considered competitive, and all movements with RVC ratios equal to or greater than 180% would be considered captive. Using the IRCS-based costing approach, the railroad's fixed cost will then be allocated to each movement to develop total cost per movement. The excess revenue per movement will next be developed by subtracting each movement's total cost from its revenues and then summed across the presumptively competitive and potentially captive groups to calculate net excess revenues for each of the two groups. The potentially captive excess return share will then be calculated by dividing the potentially captive shipper's aggregate net excess revenues by the sum of the net excess revenues for potentially captive and presumptively competitive group. For purposes of this example, I have assumed that the mix of traffic handled by UP, 90% of excess revenues are from captive traffic, as shown on line 3. Line 4 identifies the excess revenues that are available to captive shippers by multiplying line 2 times line 3. Line 5 shows the 2014 aggregate UP required revenues, assuming the captive excess revenues, line 4, are subtracted from the total UP 2014 revenues. The margin adjustment factor is shown on line 6. The margin adjustment factor is calculated using an iterative process which reduces all rates above 180% in relative proportion until aggregate UP revenues shown on line 14, column 11, equal UP target revenues shown on line 5. In this example, the margin adjustment factor equals 95.1%. I next assume that UP handled the 7 shippers shown or identified in column 1. For each shipper, I assumed a column 2 rate, a column 3 variable cost, and a column 4 annual volume. The aggregate revenues in column 5 for each shipper equal the rate in column 2 times the annual volume in column 4. The total on line 14, column 5, equals the line 1 UP total 2014 revenues. The RVC ratio for each movement is shown in column 6 and is calculated by dividing column 2 rate by the column 3 variable cost. The elasticity margin, or the price cost margin, is shown in column 7. The first adjustment is made to the column 7 elasticity or price cost margin ratios through application of the margin adjustment factor appearing on line 6. The margin adjustment factor reduces the base elasticity margin, column 7, to the adjusted elasticity margin, column 8. By applying the same margin adjustment factor to all above 180% shippers, the elasticity margins remain in relative proportion to each other. Once the column 8 adjusted elasticity margin are identified, the adjusted rates, RVC ratios, and total revenues can be calculated as shown in columns 9, 10, and 11. Also note that the total adjusted revenues on line 14, column 11, equal the UP required revenues calculated on line 5 above. In this example, shipper A is the complaining shipper, and therefore the only movement whose rate is subject to relief. This is reflected in column 12, where only the revenues for shipper A reflects a revenue reduction. The total surplus revenue subject to rebate, line 4, would be exhausted only if shippers B, C, and D also filed complaints and could prove market dominance. Otherwise, UP would retain that revenue for itself. In addition, UP retains all the surplus revenue attributed to the below 180% traffic shippers E, F, and G in this example, which means that UP's revenue would never be capped at the revenue adequacy level, which is line 1 minus line 2. The second example, following the rebate approach, is the maximum markup methodology. The example is similar to the example we just discussed from an input standpoint. The primary difference appears in columns 6, where the MMM approach that the STB has developed in its standalone or simplified standalone models is used to allocate the surpluses. Otherwise, all of the facts that I just discussed would apply equally here. For time reasons, we'll pass it back to Mr. Moreno.
In developing both variations of the rebate approach, we wanted to respond to railroad concerns that a revenue adequacy constraint would be tantamount to rate of return regulation that deprives them of incentives to invest in their infrastructure. Dr. Caves will explain how our proposals are different from rate of return regulation and also discuss the impact of our proposals on the railroad's ability to invest and expand capacity in response to this specific question which was raised in the board's hearing notice.
Thank you. Under rate of return regulation, the regulator adjusts all of the prices that the utility or the regulated entity is allowed to charge to guarantee a fixed return on the utility's assets. This is not what either of the methods we are doing proposes, just to be very clear. The yardstick approach or the benchmark approach clearly doesn't do this. It makes no reference to returns of any kind. It's simply a method for setting competitive rates in areas where competition does not appear to be present. Economists would call that price cap regulation, which is not the same at all as rate of return regulation and is generally preferred by most economists as doing a better job of preserving railroads' incentives or the regulated entities' incentives to achieve profitability and efficiency. The benchmark, so that covers the benchmark approach. The rebate approach is also not equivalent to rate of return regulation. Most fundamentally because the rebates only include surplus revenue that can be attributed to potentially captive shipments. All of the railroad's surplus revenue, as we just reviewed, all of the railroad's surplus revenue attributable to competitive traffic is completely off limits under the rebate approach. So we just want to make that absolutely clear. Therefore, the more profit the railroad can earn from its presumptively competitive routes, the less there will be available for rebate under that approach. In addition, of course, under the rebate approach, all rebates would remain purely hypothetical unless and until a shipper successfully brought a case before the STB. And similarly, for the yardstick approach, no shipper would be able to actually receive any rate relief until it proved that it was paying rates substantially above the competitive level, and it would also have to show market dominance as well, of course. So just to wrap up, the other fundamental reason why our proposals would not limit returns and would not discourage investment is that, again, by definition, the revenue adequacy standard protects a railroad's ability to remain profitable and attract investment. And it does this in a conservative way because, as I alluded to before, the STB's revenue adequacy determinations are themselves conservative. We can see this very clearly because, according to the STB's revenue adequacy determinations, the industry should not have been able to attract the billions of dollars in investment in capital that it has, in fact, attracted over the recent decades. The economists for the AAR yesterday made this point fairly clearly when Dr. Brenner pointed out in his testimony that the railroads as rational firms would not and should not make investments in which the rate of return is less than the cost of capital. And if I could continue just for one more moment to finish my thought, thank you. So Dr. Brunner pointed out that the railroads would not make investments in which the rate of return is less than the cost of capital. I most certainly agree with that. That is very much consistent with basic principles in economics. The railroads and their investors should only be willing to make investment for which the rate of return exceeds the cost of capital. But guess what? As the railroads have reminded us, they have, in recent years and decades, made enormous multi-billion-dollar investments. So while telling us all about these investments, the railroads and their economists want us to believe that they've also consistently failed to earn sufficient returns to cover their cost of capital over the same time frame. If that's true, then why in the world do the railroads keep making these billions and billions of dollars in investment year after year, decade after decade? Again, I'll just give you the figures. 168 billion since the Great Recession, 244 billion in the last 10 years, and 394 billion in the past 20 years. The vast majority of that time they would have been found revenue inadequate. So why did the railroad's project managers keep recommending projects that didn't return enough to cover their weighted average cost of capital? And why on earth did the executives keep approving these multi-billion-dollar boondoggle investments? And how on earth did the railroads manage to keep going back to the capital markets year after year, raising billions of dollars to fund these supposedly awful investments? Well, the reality has to be that the railroads and their economists are either underestimating the true returns to investment, overestimating the true cost of capital, or both. And the reality also has to be that the STB's revenue adequacy determinations are very conservative. They tend to understate the railroad's ability to attract capital. The historical data prove that. Therefore, the STB should have great confidence in adopting this highly conservative standard if it decides to regulate based on revenue adequacy.
In the interest of time, I'll just mention very quickly that we also have proposed an alternative for shippers to contest just a rate increase. This is essentially the same alternative that Western Coal Traffic League proposed yesterday. Once a captive shipper demonstrates market dominance and revenue adequacy at current levels, the STB may reasonably conclude that further increases in the differential pricing are presumptively unreasonable. Chairman Elliott, yesterday you asked the question about are rebuttable presumptions consistent with the APA. If you're still interested in that, I invite you to ask me the question. I won't take up more time on that at the moment. And I will just quickly wrap up by noting that prior to this hearing, we submitted a more detailed and written explanation and a narrative on today's testimony into the record. This was submitted, I believe, on Monday. That narrative contains further details and explanations to help you work through the examples we've done today and our proposals for implementing, and we encourage the board to consult that narrative to better understand what we have proposed. With that, I'll defer to the board to any questions you may have.
Thank you very much.
First, thank you for the effort that you went to respond to the board's request for ideas and comments and testimony, and certainly what you supplied earlier this week is helpful in understanding your creative proposal, I might even say.
I'm sorry, could I ask you to speak more directly into the microphone? Having a little difficulty.
Okay, if you're sure you want me to. And I'm not sure if this is for Mr. Crowley or for you, sir, but I think that in your testimony with respect to the rebate reduction approach, really whichever one you want to, whichever version the question kind of applies to, but I think that you said is that the board would have the ability to determine what portion of revenues would be included in the rebate reduction approach. So you could the board could sort of control how much of the excess revenues would be at risk or at issue. But then I think, Dr. Crowley, when you walked us through, or Mr. Crowley walked us through your proposals, it seemed like it was a pretty clear number based on mathematics. And so I'm not really sure which I should believe.
I think I can clear that up. The situation in which the board would be able to sort of calibrate the RMAX, I believe that's what you're referring to, that was actually referring to the yardstick approach. So under the yardstick approach, the RMAX that the board is able to set, that defines the extent to which a shipper's rate, a captive shipper's rate, is allowed to exceed the competitive benchmark. That only applies to the yardstick model.
Okay.
So the other percentage, you're quite right, is based on a calculation that Mr. Crowley can describe in more detail. But
It's more firm.
yeah, it's the data tells you what it is. Yeah.
Yeah. Tom, do you want to add anything in terms of how in the rebate approach, which is more quantitative?
In the example, we had 90% as the factor. And obviously that was an estimate. We don't have the data to make the actual calculation, but the idea is you could make the actual calculation based on the assumptions that we outline in our testimony. We start with 180% is the demarcation point, and anything to the left of 180% or anything with RVC ratios less than that would be presumptively competitive traffic, and anything to the right of that or greater than 180% would be presumptively captive. And you can calculate for each one of those movements the amount of revenue over total cost per movement that exists. And by summing those up in each of those two pots, you get two pots of money, and captive divided by the sum of the two pots equals the 90% I was explaining to you. So that could be done each year for each carrier and applied to the surplus revenues resulting from revenue adequacy calculations.
So it's a limit or a cap, ultimately.
It's kind of a floor. In other words, through this methodology, we will not assign any revenues that were contributed by competitive traffic to captive traffic through this application.
And if I can go back to one of the examples that we were using, I think it's important to note Mr. Crowley identified two pots of money, the below 180, which we're calling the presumptively captive traffic because of the jurisdictional threshold, and the presumptively competitive traffic, and the above 180, which we are describing as the potentially captive traffic, same phrase the board has repeatedly used to describe it. We are not touching the pot of money in the presumptively competitive group at all. And when we're looking at so none of that gets redistributed. And when we are looking at the above 180 group, we're taking the contribution to unattributable costs from just that group and then spreading it back via one of the two methods, proportional or the 3M method, across all of the 180 traffic. So to take this example that we have up here, let's assume that cat shippers A, B, C, and D, if you look at column 11, you see, and you compare that to column 5, the approach distributes the excess revenue back to all of shippers A, B, C, and D. Now, but first of all, we only have one complaint in this example, A. So in the example, A is the only one who gets any relief. Number two, let's assume that B, C, and D.
Don't you think the other letters will pay attention?
I'm sorry?
Don't you think the other letters will pay attention?
Yes.
Or,
So that's where I'm going now. Now assume B, C, and D also file complaints. Well, first of all, each one of them has to prove market dominance. Let's say B files its complaint and it cannot prove market dominance. The railroad retains that excess revenue that's otherwise allocated to shipper B. And let's say, but if C files a complaint, it would be, and it prevails by showing market dominance, it would be entitled to its allocated share here. The point being that shippers who don't bring complaints and shippers who don't prove market dominance above the 180 group, the railroad keeps that revenue. Because we have made sure that the entire pot of money is at least hypothetically distributed across every above 180 shipper. And only those who prevail in a complaint get their allocated portion of that. So there's no way we can drain the swamp unless every single above 180 shipper files a complaint and proves market dominance. And in that case, the swamp should be drained under our example. But that's unlikely to happen.
could you help me understand dead weight loss?
Dead weight loss. Oh, sure. Oh, I could really use another slide now.
That's okay. I mean, I have them all here, so you
Okay.
can.
Yeah. So no, I mean it's easier if you draw it on a whiteboard. No, the basic idea when economists talk about efficiency, the idea is if you're trying to figure out that you have a market for any good, right? You've got an upward sloping supply curve, you've got a downward sloping demand curve. If nothing interferes with supply and demand, then wherever those two intersect is going to be where you find an equilibrium, and that's going to tell you the price and the quantity, the price at which the good will be sold and the quantity sold. And as long as supply is meeting demand, then there's no dead weight loss in the system. And the reason is that every single unit of the product is produced as long as the value to society of producing that unit is greater than the cost to society of supplying the unit. So that's the basic way to measure efficiency in economics. If the benefit is bigger than the cost, it's efficient for that thing to be produced, for that item to be brought to market. So the problem that comes up with monopoly pricing is that the monopolist does not want to charge a competitive price. The monopolist wants to charge the monopoly price, which is significantly higher. Why? Because that'll maximize the monopolist's profits. And the reason economists don't like monopoly pricing is not so much that the monopolist gets a quote-unquote unfair amount of profit. The problem is that the only way the monopolist can earn that profit is by restricting the quantity supplied below the competitive level, right? That's how you get prices higher. You got to restrict supply. And as soon as you start restricting supply, you're going to be producing fewer units than you would under a competitive situation. And that means there are going to be a whole bunch of people that don't get to buy the unit, even though they value it more than it costs society to provide it. It's sometimes referred to as, I wish I had a whiteboard, but you can refer to it. Yeah. But I can assure you, if you talk to any of the economists in this room, if you look in any economics textbook, that's a very fundamental premise of microeconomics.
Mr. Roman, I don't mean to put you on the spot. The last sentence of your testimony, I don't know if you were reading a written testimony. Could you repeat what you said? Or maybe you were just going off the top of your head, but.
No. The last sentence I said, in order for the board to control service, it's going to need to have some type of control over how much of the increase in profit railroads are making from rate increases go back into the system. My testimony demonstrated that there was a very large portion of the operating profits that the railroads made, which were going to the stockholders, leaving the rail system. And there isn't any, as far as I know, isn't any regulation to try to regulate that. I think the railroads
I think that's probably a good thing.
I'm sorry?
That there's not regulation to regulate that. But back to some of your pie charts. I know you're trying to make a point, but to say a carload is a carload doesn't seem like a fair statement. I mean, traffic I think you used BN as the example, but what carloads they were moving, although the number may be very comparable to 2005 to 2014, the makeup of those carloads are very different, and the type of investment or the type of, even with the crude oil in North Dakota, all that they've had to do to accommodate those requests for service. It's certainly, there's a lot more to it, I think, than just what you were showing on your pie charts.
Well, actually, the line graph would have the annual carloads each year with the railroads. Your point is if a carload's not a carload, in 2014, even though the carloads were the same as very similar to 2005,
in number,
it could be different distribution on the railroad system. It could be more intermodal or less intermodal. It could be a lot of different things. The point being raised is that the railroad's capital investments appear to maintain the existing system, specifically when you get into the crude oil and you get into the frac sand movements, which are probably more important to rail than the crude as we go out into the future. Investments could have been made for that years before all these movements actually started. They knew a lot of this was going to
Well, if you
happen, but the railroads held back on investing capital in a lot of those areas, and that was the reason that you had service issues out there. They didn't have the infrastructure to support it. So it's a question of, are the railroads investing to maintain the existing system, or are they investing to increase the capacity of the system for what could be happening next year, the year after, or 5 years from now? And the service parameters that we looked at there demonstrated that service isn't improving, and those capital expenditures appear to be going in the direction of just maintaining the existing system.
Well, maybe you could help me understand it if I ask it a different way, because I'm not quite following that. But so I think that the advertisement on WTOP is that the railroad industry is putting in $29 billion this year of investment. And you're saying that the board should ultimately control and dictate even more for investment purposes rather than it going to the shareholders?
No, that's not the position of the concerned shippers. Sorry, Jay.
Okay, because that was actually what the message I was getting.
I understand that last sentence in his testimony I hadn't heard before.
Okay.
I think Dr. Caves just gave you the economic reality of what happens with deadweight loss. And the point that he made there is that when monopolists go up to the monopoly price, they do not want to increase supply. In the railroad industry, that means they do not want to increase their capacity to move more traffic. So Jay Roman's data reflects, I think clearly, that the railroads have not expanded their capacity over the last 10 years, even though they've made a lot of money. They have put $29 billion, whatever the number is, into maintaining new tunnels.
That's just for this year.
Well, whatever. But new tunnels, you heard $250 million tunnel. Well, the tunnel was going to fall down. Of course they had to replace the tunnel. Or whatever other infrastructure investment you need to make to keep the system running. That could be a lot of money. The railroad is highly capital intensive. We know that. That doesn't mean that the railroad industry is going to expand its capacity. Now, we're not here to tell you that you should regulate how the railroads invest their money. That's not what we're doing here.
Okay, good.
What we are doing here is saying we saw a parade of economic witnesses and others come in yesterday and say, oh my God, don't reduce our rates, because if you do, we will not have money to expand our system. And what Mr. Rohn's numbers show you is that they're not expanding their system, and what Dr. Caves tells you is they won't expand their system. There is no economic incentive for these four effectively monopoly railroads to expand their systems. So don't think that by putting in a revenue adequacy test or restraint or constraint that somehow or another you're going to prevent the railroads from expanding their systems, because they're not going to expand their systems.
But by expansion, do you mean that they have to have more miles in operation? I mean, technology, I think, is one of the reasons that they haven't had to expand.
That may be true, but you're having service problems. How are you having service problems when they've got all this money? The fact is they're not interested in expanding. Even the TRB report says they don't understand why the railroads aren't putting more money into their system so they can serve all the profitable traffic. They're not doing that because they don't want to do that. Dr. Caves explained why they won't do that. They're monopoly pricing. They love that deadweight loss. But the shipper, i.e. the society, i.e. our economy, doesn't love that loss. That's the point we're trying to make. We're not telling you to regulate investment. No. What we are telling you is don't think that you should not put in a revenue adequacy constraint because somehow it's going to prohibit the railroads from investing money that they're not going to invest anyway.
I'll turn it over to you guys at this point.
So, Dr. Cave, I want to go back and make sure I was understanding this correctly. I thought, if I get on my right page, that the point you made when you said the total amount that railroads had invested since the recession, 168 million over 2 years, 240 over 20 years, 394. That is what you were saying is the sheer fact that those numbers are out there tells you that they must be revenue adequate because they wouldn't do that if they weren't revenue adequate? Is that what I understood you to say?
Yeah, it tells me that a measure of revenue adequacy that says that the railroad is revenue inadequate and therefore unable to attract capital must be conservative if the railroad were in fact attracting sufficient capital to make these investments over that time frame.
And if it's not possible, it's not a big, can you go back to one of those charts, one of Dr. Crawley's charts on the rebate approach? Okay, so this one is line number 5. Are you saying that's the amount that they would have charged to their competitive traffic, and as a consequence, that's an amount that should clearly be retained and not a part of the calculation?
No, on line 5?
Is called UP required revenues.
That's the amount after you strip out the contribution to the surplus by the competitive traffic. So that's amounts that
You're saying
revenue.
that what you're calling the surplus came from competitive traffic, not from captive traffic?
No, the surplus in total is shown on line 2.
2.
And what we want to do is take out of line 2 that portion that was contributed by competitive traffic. So we strip that out,
But is that line 5?
and that is line 5.
Okay, so you'd say that that amount, in this case, 22.7.
Yeah, mathematically, those lines actually follow one another. You start with UP's total revenues of 23.8 million in line 1. We've calculated the surplus as $1.273 million. Now, if you were, and what we've now taken is 90%, line 3 takes 90% of line 2 to generate line 4. And line 1 minus line 4 equals line 5. So what that 90% represents is, and this is a hypothetical, the 90% is the portion of line 2 that was contributed by above 180 shippers.
Okay.
So that creates the above 180 pot of money.
Okay.
And everything that's left over is the below 180. Now,
Okay.
whether 90 is the true number or not, we don't know. That's a number we picked out of the air.
So one of the things that I'm curious about, going back to the TRB study and the way you've looked at doing this, is they also said that IRCS is desperately flawed and shouldn't try to fix it. But the 180 comes out of IRCS, correct? So are you uncomfortable with the notion that our current way of figuring out who's above and below 180 is coming from a system that at least, you know, some set of researchers?
I would add as a beginning, the pretext or the guidelines that we used for calculating this, one of those guidelines enumerated up front is consistent with current statute. What
true.
the board can do today. What the TRB is concerned about is a policy debate that can be had down the road, but we need to deal with what we have in front of us right now and the tools we have, and that's how we've come up with this approach.
And then particularly, I guess it would be on the benchmarking approach. In order to do that I mean, the way I understood what TRB did was they used the information that could be derived from the waybill sample.
Combined with some other data, yeah.
And if we were truly going to use this as our method for regulation, is the information available through the waybill sufficient to create this kind of statistical model to predict what a competitive rate would have been?
No, it'll get you most of the way there, but the TRB had to go outside the waybill, and they were able to go outside the waybill. They obtained information to try to approximate the availability of competitive alternatives from external data sets. So they would take the location of a station, they would map it to a latitude and longitude from some other database, and they would figure out, okay, they basically constructed a crude metric. How many Class 1 railroads are within 10 miles? How many ports are within 20 miles? Mr. Moreno earlier was making the point that the STB would probably want to consider something a little more precise. After all, the TRB was doing it illustratively. But that should be feasible. There would be some upfront cost to it for sure. But supplementing the CWS with some reliable indicator of effective competition should not be insurmountable. And we have more details on that in our written testimony.
So if one were interested in pursuing this sort of an approach, part of what it requires is, sort of then figuring out what your comparable traffic is, so you're comparing the rates back to comparable traffic.
Yes.
Are there complications to that, just sort of knowing what you really could call comparable and not comparable, is that something that could be debated for years?
It's similar to a market dominance determination that you do in a rate case. It's similar to commodity exemption.
Oh, but it's more transparent than that, right? Sorry to interrupt.
Go ahead.
But at least, if you estimate a reliable model, then you have a very transparent way of determining what traffic is comparable, right? Because the model tells you how the different shipment characteristics relate to the
So what you
rates.
would know what the characteristics are. So
Yeah.
you're saying it's transparent because you can make a judgment call if you felt like, in fact, those characteristics were the same.
Yeah, well, and the model will tell you. If there's some characteristic that doesn't matter, the model will tell you, hey, this coefficient is insignificant. Drop it out of the model. We don't need it. That's an objective standard that you can use. Sorry to interrupt.
Yeah, in the illustrations that Dr. Caves used, he created a very simplistic one that assumed there's just one variable, distance. Obviously, when we get into this, you're going to have to come up with several variables.
Yeah. So I thought it was great that Vice Chairman Begeman asked about dead weight loss, because I had that on my list too. But unlike her, I wish you did have a whiteboard, because again, I'm pretty sure I would have understood it better if you were drawing on a whiteboard. And by the time Mr. Donovan was finished with us, I concluded that actually was a fairly important thing to understand.
He's creating
He's
his own.
drawing. I know. I see that.
I didn't wish to imply that I didn't think it was important to understand.
All right. Let's see. Is there a projector or something I can use? I can just kind of hold it up.
We don't have an opaque projector.
You can just come up here.
You can approach the
All
bench.
right, I can approach the bench. Okay. All right, so here's the way it works.
Do you want a microphone?
So I'm showing a supply and demand graph here. You've got upward sloping supply, which shows the marginal cost of producing some product. Doesn't matter what it is. You've got demand, which shows how much people, consumers, society value the product, right? The more of the product that's produced, generally the more it costs to produce it. And
The more that's produced, the more it costs to produce it?
right, so marginal cost tends to increase, right? At some point, for example, the railroad just hits capacity constraint. It can't accept any more shipments on this railroad, so the cost goes up. The cost curve could look different, but that won't materially affect because you're right, the marginal cost tends to go downward, but this will make it more concrete. The demand curve slopes downward because the more you sell, the lower the price you can sell it at, is the basic idea. So if we produced only this much, so suppose we're way back here at this quantity level, the demand would be very high. People would be willing to pay a very high price because it's in such short supply. On the other hand, the cost of producing that much is relatively low. So that tells us it's not efficient to be at this production level. You need to keep on moving to the right here until you get to this level. Because when you're at this level, you know that you've gotten to the point where the value that someone places on buying that product is just equal to the cost of producing that product. And the problem with monopoly pricing or distortionary taxation can do the same thing, is that it will move you away from this optimal quantity. And there will be all this output that never gets produced, even though the benefits of producing it are greater than the costs of supplying it. So that's the idea.
Thank you.
Yep.
Okay, I'm done. Yeah, thank you.
I think we'll probably have to enter that into evidence just because it was described. And I mean, take your time. I don't think it'll be controversial because you were explaining, I think, a basic economic principle.
That should be very uncontroversial, yeah.
Yes. So, but I think just because it was a little unorthodox that we should at least have the exhibit in evidence for reference of the other parties. I just had a few questions. First, with respect to the rebate, yesterday we were discussing similar rebate proposals with the carriers, and the carriers, one concern was it would have an asymmetric problem. Do you agree with that statement that you're only going to be recovering on the high end above revenue adequacy, but what are you going to do below it?
Is there going to be a problem? Which method were we asked about?
The rebate.
The rebate method. So, of course, the issue here is that you will never. It doesn't really apply because regardless of whether you're on the upside or the downside, you never go so far on the downside that you have a disincentive to invest. I think that's really the answer. The asymmetric regulation argument assumes that once you go on the downside, oh my gosh, your returns are so low that you're not earning it above your cost of capital. So why would you make a productive investment? But if your returns never get that low, it's a non-issue.
And under the rebate approach, the railroads can still earn above their cost of capital and retain that excess earning. All we're rebating here is the excess contribution from the captive shippers, the above 180 shippers. The railroad keeps the excess contribution from the below 180 shippers, and it also keeps the excess contribution from the above 180 shippers who aren't truly captive because they can't produce or because they can't show market dominance. So to the extent the railroad is engaged in enhanced pricing of its competitive traffic, which is what UP, for example, in this proceeding has attributed most of its financial success to, it keeps that revenue. We're not touching that. We're dealing with differential pricing of the truly captive market dominant shippers and refunding only their excess contribution.
And back to the benchmark model that you explained that was, I guess, also in reference to the TRB model. Talking to the economists about, I asked questions about that yesterday. With respect to their analysis, they did not have a huge problem with it, the model itself, but their conclusion was that it would lead you back to something as complex or similar to SAC. Do you agree with that? Their analysis?
I don't agree, and the TRB doesn't agree. The TRB had a long time to think about these issues and a long time to put that report together, and they had a very distinguished group of economists working in a, I think as Dr. Cull put it, a non-disputatious environment, which is what he said he preferred. And they concluded that the yardstick approach was the way to go.
Thanks. And also, with respect to the yardstick approach, I know we're talking about it in the context of revenue adequacy, but were you looking to use that as a broad measure or to be a trigger by revenue adequacy? Just so I'm clear on that.
Well, I think, well, I don't know what the official position is, but I think none of this stuff could be triggered until revenue adequacy were achieved, right? I mean, isn't
Right.
Yeah.
You would have to be revenue adequate in order to even employ the yardstick approach.
Yeah.
Okay.
So you would, and we would advocate using the methodology that Mr. Crowley demonstrated early on as to how you calculate revenue adequacy using the 6-year rolling average that he used the UP as an illustration.
A final question, not completely on point, but we've been talking about the SAC test, and as you mentioned earlier in your testimony, I think you led off with it, that it doesn't seem to be effective. You've been a very active practitioner on behalf of your clients in these types of very complex chemical cases, and is there a reason why I can see that the SAC tests that you've brought are very, very complicated. Is there a reason why the shippers that you represent aren't bringing simplified SAC cases, just to take some of the complexity out of it?
Yeah, there's a couple reasons I can say about that. One is simplified SAC. The simplifications in simplified SAC tend to generate even higher rate levels simply because the primary simplification is the elimination of the opportunity to remove inefficiencies from the system through the SAC analysis. So we start out probably at a higher rate level. Number two, the amount, the duration of the rate relief is only for 5 years as opposed to 10 years in a SAC relief. Simplified SAC, although simplified, is still expensive. It's still over $1 million, probably closer to $2 or $3 million in actuality. And the board recently made it more complex by even changing the road and property investment simplifications by making it more complex. So the litigation cost of litigating simplified SAC for a return that is less that is a smaller return over a shorter period, it doesn't make the internal cost of capital from our client's perspective. I think it would be helpful if the board were to extend the duration of the remedy to 10 years, because I think that would make the economics of bringing a simplified SAC more attractive.
Thank you. That's very helpful. Any other questions?
Could I just,
Sure.
Jeff, I might have two quick sort of questions. A few times you mentioned the hurdle that, but of course, each shipper would have to prove market dominance. I realize that it's not an automatic that a party is market dominant, but certainly the board, has gone out of its way. I'm not that I've always agreed with what the board has done, but has created a new limit price approach. Are you suggesting that it's somehow the board's approaches for considering market dominance are overly restrictive?
No, I'm not here, and I'm not intending to critique in any sense the board's approaches to market dominance. I'm just making the point that market dominance must be proved before any shipper is entitled to their hypothetically allocated share of the rebate. Otherwise, the railroad retains that.
Right. It's just that but part of achieving that certain figure was that you'd already assumed they were that's within that captive traffic group.
Well, they were potentially captive.
Right.
Yeah, right. Above 180 is potentially captive. Below 180 is presumptively competitive.
Right.
There's probably captive shippers below 180 too, but
Okay.
we have to make some simplifications.
And then just one last thing. With regard to the revenue adequacy constraint, I think from your very beginning of your testimony, I think you said that you supported Western Coal Traffic League's proposal, or
we support Western Coal Traffic League's position in Ex parte 664, and also that we had advocated a similar revenue adequacy constraint to Western Coal Traffic League as a constraint or limit upon rate increases.
That's actually what I want. So it's you see it as a constraint on an increase.
Yes, and that would be an alternative. A shipper might decide, look, we don't want, it's still too complicated, too much time. We're not really interested in going in and trying the rebate approach or the market approach. We just want to keep our rates at a reasonable level and minimize the level of differential pricing. If a carrier is already revenue adequate, it should not be entitled to additional levels of differential pricing, and that's the presumption that would come about as a result of this rate increase limitation.
Thanks for clarifying that.
I wanted to go back because I'd meant to ask this earlier. And so in terms of the time frame, you would recommend 6 years and to do it as a rolling average, as opposed to one of the parties yesterday was saying 4 years, but your recommendation
and I
is
think
6.
we probably haven't made this point abundantly clear, but we believe measuring revenue adequacy should be based on a rolling 6-year basis because that's the average length of the business cycles in the post-World War II era. We would then, on the flip side, say that the rate prescription that comes from either the yardstick or the rebate approach would be for 6 years.
4 to 6 years?
No, would be 6 years.
Thank you.
Thank you very much for your testimony. Very much appreciated.
Oops, that worked pretty well. I'll throw that away. Take it home with me.
I think we're going to swap because she's down there. Thanks.
Okay, why don't we begin with panel 4?
Okay, great. Good afternoon, Chairman Elliott, Vice Chairman Begeman, and Commissioner Miller. My name is Paul Bischler. I'm the Vice President of Finance and the Chief Sourcing Officer at BNSF Railway. And in my role, I oversee the Treasury Group, which handles the debt placements we do in both the private and public markets. I also oversee the risk management function, as well as the financial analysis that's done when we look at determining whether or not a project exceeds its hurdle rate. Also, I've got the purchasing organization, which supplies many of the resources we use to supply our capital infrastructure projects. So before I get started, I did just want to comment on a few things. I appreciated, frankly, yesterday at the beginning of the testimony, Chairman Elliott, you said that you wanted to make sure there was a thoughtful, balanced decision-making in this proceeding, which I very much appreciated. Same thing to you, Commissioner and Vice Chairman, and your comments around making sure we don't roll back the railroad industry. I've been in the industry now for 20 years, and I can tell you many times during that part of our career, some of our aspirational goals were to grow. We hope to grow. We hope to invest, and that's what we talked about. So my testimony today is really going to focus on two key points that we think are important. One, investment, and two, regulatory balance. So first, BNSF's investment has been unprecedented, and our customers have responded by making their own investment of capital and volumes on our railroad. The current regulatory environment is generally working exactly as it should. We have a safe and reliable railroad that over time has been able to handle our customers' growth with improving operational efficiency. Second, the board must continue to strike the proper regulatory balance. We are very concerned with some of the proposals to adopt industry or commodity-wide caps because we believe that will disrupt our business model, which focuses on growth and investment. However, we understand the board would have concerns about unlimited rate increases for certain shippers if and when railroads consistently earn revenues significantly in excess of a reasonable return. We believe the board should continue to address rates that are excessive through an individualized analysis. So I want to start by talking about investments. And up on the slide there, you can see BNSF's business model. Frankly, it's focused on growing with our customers. We will invest if we're able to grow our business, improve our operational efficiency, and receive appropriate value for our services. This enables us to earn appropriate returns, which creates an incentive for us to further expand and continue this virtuous investment cycle. BNSF has had a long history of investing to improve and expand our network to the benefit of our customers and the overall economy. Since 2000, we have invested over $50 billion in infrastructure and equipment. Since that time, we've replaced approximately 44 million ties, over 11,000 miles of rail, and added more than 30 million tons of ballast. I did just want to pause here, given the comments of the preceding panel. One of the things that's important that I thought was overlooked, if you look at that blue line, that's growth. And when we talk about investment, that's why we've been investing a large portion of our funds. It's to help ensure we're able to be there as our customers are growing. And Vice Chairman Begum, and you correctly pointed out, they arbitrarily picked 2005, which was one of the high points of carloads. The mix of business on our railroad has dramatically changed. A lot of our investment has gone into the northern corridor, which is where a lot of our newer volumes are moving now. And the last thing, they talked about service and the fact that service isn't improving despite the investment we're making. The simple fact of the matter is, when we look at our customer surveys across our broad base of customers, that's not what we hear. Over time, the marks we've gotten have improved. Now, I will say 2014 was a horrendous year, and you certainly wouldn't have seen that from our customers. But prior to that time, you saw consistent improving service marks. With regard to adding new capacity, BNSF has added 536 miles of double and triple track, constructed 33 new passing sidings, and extended 35 sidings. These projects, along with targeted terminal expansion projects and signal system upgrades, have allowed BNSF to accommodate business growth on a continuing basis. As demonstrated by our plan to invest an industry record $6 billion in 2015, following our record $5.5 billion investment in 2014, we will reinvest in the business when we have a reasonable degree of certainty that we'll be able to achieve a reasonable return on our investment. Today, our $2.9 billion maintenance program is what our entire capital program was just 10 years ago. Our customers are also investing in our future. My colleague, John Miller, appeared before the board last month in the grain proceeding. He talked about how BNSF's agricultural customers were responding to our level of investment by making their own significant investments in BNSF-served facilities. We believe that our customers' investments are indicative of their belief in our ability to provide excellent service over the long term at market-responsive rate levels. We see this kind of investment from customers across all of our business units. Since 2000, we've increased the volume on our railroad by over 2.1 million units. And every year since 2010, our volumes have grown year over year. The slide that's up now highlights our investments since 2010. Because of the anticipated growth of our customers, you've seen broad geographic investment across our entire network. This will benefit all of our customers' business. It is well known that most forecasts of future traffic trends show that there will be an ever-increasing demand for rail services, and thus a need for additional rail infrastructure in the U.S. At BNSF, we certainly believe demand for our services will continue to grow, and the strategic investments made by BNSF will enable us to meet this ever-increasing demand for our services. But while our belief in our customers' future growth has driven us to invest, a critical factor allowing us to make these private sector investments is that we've had a relatively stable economic regulatory environment that's been conducive to investment. I want to emphasize how important regulatory certainty is in our investment decisions. The principles embodied in the Staggers Act appropriately balance the needs of certain customers to access rate relief with the recognition that our industry must be permitted to earn revenue sufficient to justify reinvestment. Those principles have incubated the growth and investment we've experienced in the past decade and supported BNSF's model focused on growing with our customers. The board is very familiar with the service deterioration experienced by BNSF customers at the end of 2014 and 2014 as a result of significant unanticipated volume growth that exceeded available capacity in key areas of our network, combined with harsh winter operating conditions. The dramatic and persistent downturn in velocity across our network, in combination with growing volumes, left us with a choice. Either we respond with investment to build the capacity that will restore and ultimately improve service for all our customers, or operate with insufficient capacity to serve all of our customers current, much less their future demands. We chose to respond with massive investment, and that strategy is working. We have experienced notable performance improvements in all key measures. As you can see in the attached slide, our overall train velocity, as measured in miles per hour, has improved by 11% since last summer. We have in turn seen a dramatic reduction in the average terminal dwell experienced on shipments moving across our system. Our customers have already begun to feel the positive impact of these investments in the form of improved service and increased reliability. But the benefit of these investments are not short-term. The investments we made in 2014 and 2015 will benefit our customers and the U.S. supply chain for decades to come. However, it is important for the board to understand that when we decided to make these large capital investments in 2014 and 2015, each individual project had to undergo a rigorous financial analysis. Will the projected returns justify making the investment? Unfortunately, when we perform these financial analyses, we don't have certainty into whether or not the estimates of future volumes, market conditions, and costs are accurate because of the long time horizon it requires to ultimately pay us back for these multi-million-dollar projects. Many of our projects require decades to achieve a reasonable rate of return. And many of the markets we serve go through business cycles and are subject to disruption. The testimony I heard from the coal groups is a great example of long-term investment risks faced by BNSF. A decade ago, when we began increasing our investment in our coal business, no one could have predicted the downturn we are seeing now. Even as late as 2014, coal customers were demanding that BNSF invest and add more capacity for coal. Yet, in the past year, BNSF has seen a structural change in the long-term outlook for our coal business. We expect that we will see a drop in these long-term investments. Coal is not the only market where we've seen the risk profile change. As we sit here today, it is already clear that many of those projects that we invested in during 2014 and 2015 will take longer than we anticipated to achieve a reasonable return. And there's no certainty that it will happen. That's frankly the challenge that we face when we make these long-term infrastructure decisions. When should I make it? Where should I make it? And can I count on the earnings to occur over a long period of time? Uncertainty about possible regulatory changes creates another layer of risk on top of those business risks I just described. And there is always a risk of regulatory processes, such as environmental permitting, causing unanticipated delays in getting those projects off the ground. As a result, we have to make investment decisions based upon a risk-adjusted threshold. The greater the risk, the higher return we will require on the project. If the types of artificial rate caps now being proposed had been in place in 2013 and 2014, we simply would not have been able to respond to the service degradation that we experienced with the same level of investment. We would have placed a higher degree of risk in our financial analysis, and that likely would have led to lower investment in those years. It is important to note that despite being a subsidiary of Berkshire Hathaway, we are still subject to similar market forces to compete for capital. We must demonstrate our ability to generate returns and cash flows required to service our capital requirements. If we don't, our investors will find other alternatives for their capital. Keep in mind, our investors are not just Berkshire Hathaway. We also have investors in our public and private debt. Rating agencies monitor BNSF's financial health, including cash flows and earnings relative to borrowing levels. If not managed properly, that can impact the cost of our debt and ultimately our ability to fund our investment. Therefore, BNSF's approach to our investment decision works exactly the way it did before the Berkshire Hathaway acquisition. Each capital project, whether small or large, must undergo the same rigorous financial analysis. As I mentioned earlier, my team performs the analysis, on all projects to ensure they provide for a reasonable rate of return. Once complete, projects generally require approval by a cross-functional team of our executives. All of this ensures we make the best decision possible given the facts and circumstances at that point in time. In summary, I would just say every decision, whether or not we invest, is all about risk and returns. Because we are investing in long-lived assets and spending is front-end loaded, but the returns are earned over the life of the asset, significant risk already exists when we invest in our infrastructure. As I mentioned earlier, one of the key aspects of our business model in this virtuous cycle of investment is ensuring we drive operational efficiencies. Operational efficiencies help us increase the value of our service to our customers and offset cost pressures and inflation. This has a significant impact on our ability to achieve reasonable returns. Each year, we analyze numerous investments geared toward generating operating savings out into the future. We assess those projects to ensure we will achieve a reasonable return on the capital spent. These type of projects are great for our customers as they generally involve improving the fluidity and efficiency of our railroad. Another important aspect of incentivizing lower costs and innovation is it drives our suppliers to develop new and innovative products. As the railroad industry has grown, so have the resources and the capability of our supply base. I see this firsthand today in my job. The amount of innovation our suppliers are doing is greater than it's ever been. Today, our suppliers understand we expect them to continually enhance their products to grow with us. As you can see from this slide, the number of rail equipment incidents and the reliability of our railroad has improved substantially in the last 10 years. The joint efforts of the railroad and rail supply industry to innovate has been a main driver of this improvement. From higher quality rail to railroad tie life extension to improved methods to enhance the surfacing of our railroad to the massive technology that is being invested, all of it happens because we work together with our suppliers to drive improvement. Today's regulatory environment permits exactly the type of behavior the board and the railroad's customers would want to see from us. We constantly challenge ourselves, can we do better? However, proposals that we have seen from participants in this proceeding represent significant risks in our ability to continue the current level of investment. RVC-based proposals, in particular, have very negative consequences that are contrary to the public interest and the interests of our customers, and have the unintended consequence of penalizing railroads who make efficiency investments. To conclude, I would like to take us back simply to our core message today about investment and regulatory balance. BNSF has heard the complaints from some shippers about their inability to access the board's existing rate review procedures and would support efforts to address those concerns. But BNSF strongly opposes the adoption of any company-wide or commodity-wide cap on returns like those that have been proposed by several commenters in this proceeding. BNSF understands that the board might be concerned about the highest of the high rates charged by a revenue-adequate carrier to certain shippers, but the board should not overreact with regulation through firm-wide constraints or rate caps. Those rates should continue to be addressed through an individualized analysis that does not disrupt the important regulatory balance that currently exists. I will end by reiterating BNSF's business model is focused on growing with our customers. We have made unprecedented investments that have allowed us to grow and improve our service and efficiency. Our customers have responded with their own investments and increasing volumes on our network. This investment cycle is precisely what board policy should continue to encourage going forward. That's the end of my testimony, and when we have questions, Jill Mulligan will assist me.
Jill, could you pass the clicker down, please? Good afternoon. I'm Lou Ann Wren, and we are very pleased at Union Pacific to have the opportunity to address the very interesting and compelling topics that are the subject of this hearing. I am particularly pleased to be able to introduce our two witnesses. The first is Professor Kevin Murphy, who is the professor of economics from the University of Chicago and also affiliated with Charles River Associates. It's been a long 2 days, so I am not going to try to reprise his very extensive qualifications and credentials. I'll take a little bit longer, however, to introduce my colleague, John Panzer. John Panzer and I first began working with each other when we were investor relations together. He went on to other responsibilities in the finance department and then spent over a decade in intermodal marketing and chemical marketing before returning to finance recently to take over as vice president of planning and analysis. John is going to discuss how Union Pacific addresses or deals with how we make investment decisions and what the implications are for the issues that you are dealing with here. Professor Murphy is going to take a step back and look at some of the broader policy issues and address some of the questions that you've been raising over the last 2 days. John?
Thank you, Luann, and thank you for the opportunity to speak to you today. My responsibilities at Union Pacific include capital budgeting, which involves analyzing potential capital projects and determining which ones get funded and which ones do not. I understand that the board is considering proposals to impose new constraints on rail rates and revenues once railroads achieve so-called revenue adequacy. If adopted, such proposals would impact our capital spending decisions and force us to reduce our capital investment, especially in projects involving new capacity. In my remarks, I'll describe Union Pacific's capital budgeting process and how demand for capital spending has changed over time. Then I'll explain how the types of rate constraints being considered by the board would affect our analysis of projects and force us to reduce investment. At Union Pacific, my team analyzes proposed capital investments using the same valuation and capital budgeting techniques that are very common at most corporations. We're presented with a proposed project. We calculate the expected return on investment, or ROI, which is based on the size and timing of future expected financial benefits. We then consider where the ROI is sufficiently high to justify making the investment. The forward-looking analysis we use in evaluating ROIs and whether to make investments is very different from the backward-looking historical analysis that the board uses in its annual revenue adequacy calculations. The board is measuring the rate of return generated by all existing assets in our entire enterprise, and we call that return on invested capital, or ROIC, but it's a measure of past performance. New assets are added to our total investment base through our capital spending program. To ensure that our ROIC remains above our cost of capital, we have to ensure that each new investment that we make generates an ROI that at least achieves our cost of capital. And at this point, I want to make a comment, because it was discussed extensively the last couple of days, about deferred taxes. Deferred taxes are an outcome of what we call bonus depreciation, which is rules established by the IRS that encourages companies to spend money or invest today by giving them tax benefits on those investments that occur sooner than they would otherwise. The net effect of all that is for bonus depreciation to increase the expected returns on projects. And so by excluding deferred taxes from the ROIC calculation, the board is effectively eliminating or reducing that incentive that's created by the IRS to make near-term investments. The distinction between the forward-looking ROI and backward-looking ROIC calculations is important to understand. In fact, it answers the question about how the railroads have been able to invest in projects even before they became revenue adequate, and that's because future investments are all based upon forward-looking economics, not backward-looking. Since ROIC is measured by the board is backward-looking, it really provides no useful information about the prospects for earning a good return on future investments. This difference helps explain why the board focusing on what is called revenue adequacy could depress returns on future capital investments and reduce the railroad's opportunity to meet customers' needs for capacity and service. Union Pacific generally classifies capital investments as either replacement or growth. Replacement capital projects are investments to replace worn or retired assets that continue to be needed for operation of the railroad. These projects carry relatively low risk because they're intended to allow us to continue to handle established traffic. Growth capital projects are investments to enable the railroad to grow the volume of business we handle, improve service for our customers, or increase efficiency. Most of my team's efforts are dedicated to analyzing growth investments. These projects require more scrutiny because they're often associated with new sources of revenue or significant operating changes. This makes them inherently more risky than replacement projects, and the potential future benefits are more difficult to analyze. To the extent that we have funds available to make investments, but there are not enough projects that will deliver adequate returns, our shareholders expect us to return cash back to them through dividends or share buybacks. This allows them to invest in other activities that have greater prospects of generating higher market-based returns. Union Pacific is experiencing high demand for investment in growth capital. In my job, the challenge is ensuring opportunities for growth result in benefits that are sufficient to provide a return on those investments. In the years following deregulation of the railroad industry, relatively few growth capital projects were undertaken. Railroads were forced instead on increasing productivity by rationalizing their networks and eliminating unprofitable line segments. The need for growth capital increased following the UPSB merger as we undertook new construction projects to connect the two railroads and to support the then growing demand for Powder River Basin coal. Spending on growth capital then slowed until the mid-2000s when rising demand supported increased rates, helping generate a level of expected returns that justified additional expenditures in growth capital. Since 2003, Union Pacific has spent over $6 billion on growth projects, such as adding new track, yard, and ramp capacity. I'll mention, while our total volumes since 2005 have not grown, our service has improved dramatically. And also, the demand on our network has shifted. It started in the early 2000s to be more Midwest-oriented to support coal growth, and then more westerly to support intermodal. And now we're seeing increased demands in the southern part of our railroad to support energy and chemical markets. So the capacity has been added. It's just that demand across the railroad has shifted. But with these opportunities come challenges. The cost of adding capacity in our system is rising. We've constructed sidings, crossovers, and connections where they've had the biggest impact on throughput. But to make equivalent impacts in the future, we'll have to make even more extensive investments, like adding miles of double track. Investment requirements are also increasing because demand is rising in congested areas. For example, in Texas and Louisiana, we face high land acquisition costs and other factors that make construction more challenging, including moving a large number of pipelines and dealing with environmental and permitting challenges. The challenge isn't finding investment and opportunities, but finding projects that generate sufficient return to justify these increasingly costly investments. The new rate constraints proposed in this proceeding would increase the challenge in finding projects whose ROI would justify the investment. Such constraints would reduce capital expenditures in our rail network by reducing the number of projects that could deliver adequate returns. As I've explained, when we're deciding whether to fund a project, the question isn't whether we have a particular system-wide ROIC, however you measure it. The question is whether the project is expected to deliver sufficiently higher returns when looking only at the future investments that project will generate. When we invest in growing our network, we expect the investments will help us handle traffic at a sufficient level of profitability to make the investments worthwhile. If rates are subject to new constraints based on concepts of revenue adequacy, fewer projects will produce sufficiently higher returns, and fewer projects will be funded. Again, this has nothing to do with our historical overall level of return or our ability to access capital. It is probably easier to see how this is true for projects that would directly benefit traffic that is subject to rate regulation. For example, an investment that primarily benefits an exclusively served chemical facility might not be undertaken if rates were capped under revenue adequacy constraint and our expected return is too low to justify the investment. But as I understand the proposals before the board, Application of a revenue adequacy constraint would also reduce our investments in projects that would directly benefit exempt commodities or business under contract. If earnings from those investments are used to provide refunds or trigger rate caps for other traffic, then that regulatory tax would reduce our expected returns, and inevitably we would be left with fewer projects. Most investment opportunities involve circumstances somewhere in between my two examples. They would directly benefit some traffic subject to regulation and some that is not. But in every case, the type of new constraints that are being proposed would reduce expected future benefits and therefore force us to reduce investment. And even when we invest, the types of constraints being discussed could distort those decisions. If one project with otherwise high returns faces greater regulatory risk, then that project may not be undertaken in favor of another project with lower returns but lower risk. In other words, new constraints would change the flow of capital dollars by overriding market signals. In summary, we believe that continued capital investment is critical to meeting the ever-changing demand for rail service. Our capital spending increased substantially in the past decade in response to shippers' demand for new capacity and improved service. But sustained high levels of investment are only possible if the expected returns are sufficiently high to drive dollars back into our network. The types of new constraints being discussed in this proceeding are especially troubling because they are focused on historical returns, which have nothing to do with the forward-looking analysis that we use to make investment decisions. Use of the concept of overall revenue adequacy would interfere with market signals that identify what would otherwise be sound investments. Interfering with the free flow of capital to the best projects will distort investment decisions and inevitably reduce capital investment in our network. Thank you for your attention.
Okay, sorry about that. I saw the light wasn't on, so I guess the light just doesn't work. Anyway, well, thank you very much for having me here today. It's really a pleasure to have the opportunity to talk. I'm going to try to go through much of what was in my written work, but also try to tailor it around answering some of the questions that have come up over the last few days. And if there are any additional questions or further clarification, I'd be happy to answer those after I'm done. Anyway, one of the things we've heard a lot about is, well, the railroads have had a lot of big improvement in their performance, haven't they? Don't they have plenty of money to make the investments that are needed? And I think it's important to do a couple things. One is think about a little history and how we got here, and also to go back and review the underlying economics of investment, much of which John just talked about. So in terms of the history, the largest historical improvement for railroads came from rationalization of the network and improved operations that came after the Staggers Act and partial deregulation. Over time, excess capacity has been reduced and many of the bottlenecks have been removed. This has led to higher productivity and lower rates to shippers. That's a history you're well familiar with. However, there's a flip side to this. This has left the railroad industry in a situation where further progress cannot be obtained simply by rationalizing what we have. Further progress requires that we make even larger investments going forward. That's, I think, what John just talked about here. And I have a chart that kind of illustrates that. This chart looks at the amount of expenditure per track mile over time for UP's network. And I think what you can see is that the amount of investment, the intensity of investment is much higher today, because we're not just taking a network that had a lot of excess capacity and rationalizing it. In order to meet the ever-changing nature of demand today, you have to build new things. You have to add new capacity in different places. And it's important to remember, it's not just about total carloads. I think this came up earlier. When demand shifts, when we switch from Western coal to shale gas, that requires additional investment because they don't reutilize the exact same assets that were used before. And so you have to take this into account. So, the fact that railroads are revenue adequate doesn't mean that investment is insensitive to what you do. That somehow, well, they're making enough money, returns are high enough, that's not a concern we have to have. Okay? So go ahead. Another key point is that the improvement over time in investment is not just about meeting a specific customer's needs. One of the things that happens through investment is you're able to improve the overall efficiency of the network, make the network run better. And the charts I put up here on the left actually measure two service quality metrics. One is slow order miles and slow order delay hours on the left and how they've changed over time. And you can see that while they did tick up in 2014, that followed a prolonged period of improvement in the slow order miles on the UP network. The one on the right is the customer satisfaction index. Again, I think the other railroads have referred to some of these same things. Again, those show improvements. And what this means, and you have to remember, railroads are a network industry. So if you fail to make investments in one part of the network or for one shipper, often that will spill over to affect other traffic. And that's an important thing to keep in mind. It's not, that they're going to tend to have pretty broad effects on the networks. So it's not about, when you think about investment, another important thing to remember, it's not about whether the railroad has the money. It's, as John said, that's not how they make the investment. They don't say, God, we got enough cash, let's make the investment. They look at it, what's the return? Is the return there? So when you think about regulations, you want to think, how are those regulations going to affect the return and the allocation of investments? So that leads me to a second question. You've heard a lot from the railroads over the last couple days that many of the shipper proposals amount to some broad-based rate of return regulation, and you've heard other arguments to the contrary. And you also heard the fact, and this is a question I think was raised yesterday, is, well, isn't this a small segment of the marketplace and therefore not such as big of a concern as it might otherwise be? That is this regulated traffic very small? And the question you have is, well, which is the right way to think about it? Well, the key thing to remember about rate of return regulation, its most pernicious effects come because you're monitoring the returns. You've now changed the company's incentives to not what's best for their business, but what fits best with the regulatory environment. That is, they tend to invest in things that are measured or even over-measured in the measurement of returns, and they underinvest in things that don't count. If you start linking things too tightly to RVC ratios, well, there's two parts of the RVC ratio. There's the cost and there's the revenue. And one way to make sure your RVC ratios aren't too high is to make sure your costs are higher. Again, you got to be careful about the incentives that are induced. And the thing about a revenue adequacy-based constraint, whether it's something that explicitly looks at the surplus over revenue adequacy or something that's triggered by revenue adequacy, is that revenue adequacy is a company-wide measure. And therefore, if you link something, you do something, you'll be regulated more heavily, you'll be subject to price caps, whatever it is, and you say that's linked to the attainment of revenue adequacy, that company's going to have an incentive to try to avoid revenue adequacy. And you can avoid revenue adequacy not just by changing what you do on captive traffic, but changing what you do on any traffic in your network, because that's how you're measuring revenue adequacy. And to me, that raises this issue. It says, I got this small segment, maybe it's 5%, maybe it's 20%, whatever you want to say it is. I'm worried about that, but I'm going to link it up to this broad measure of revenue adequacy. And all those well-documented and well-understood adverse effects of rate of return regulation that have been, we've seen them in other industries, they're well established in the economic literature, are then going to be present across the system, not just on the regulated fraction of the traffic. Secondly, you have to take account of the fact that the regulated part of the traffic is not a constant. That is, there's going to be incentive effects. That is, more and more people, you make it attractive to be under the regulatory regime, more and more people are going to go there. So maybe it's 5% at one measure, it won't stay at 5% if you change the picture. I'm sure I've covered what I wanted to say here. It's also important to remember that the impact of regulation is not about whether we will drive railroads below revenue adequacy. And that's an important point. That is, it's not like there's revenue adequacy and then revenues above that are kind of this extra that really aren't needed to support investment. That's just not the right way to think about it. Think about what John talked about a minute ago, or what was brought up yesterday in Dr. Brenner's testimony. The way a company does its capital investment decisions is they have a hurdle rate. Let's just say it's 11%, just because that's what Dr. Brenner used yesterday. I'm going to stick with the 11%. They have 11% hurdle rate. You have an investment that has a return of 13%, you'll do it. If you make changes to the regulations by taxing the returns implicitly through revenue adequacy constraint, or lowering the rates that you can charge to the shippers served by that, and that falls to 10%, that company will no longer make that investment. That will be true even if the overall average return is still above revenue adequacy. That is, you will still lose investments even though overall you're above revenue adequacy. That's not how firms think about it. They don't say, on average, are we covering it? They ask, for this project, are we covering it? So you have to worry about that side of it as well. Okay, so I think that's an important thing to keep in mind when you think about the investments that in the potential effect on investments. It's not about, well, they'll still be revenue adequate. We're not going to take it all away, so they'll still be above. That doesn't tell you you're not affecting investment. In fact, you will be affecting investment as long as you affect the returns on individual projects. Again, the other side is, well, don't they have plenty of money? They're paying out to shareholders. But again, it's not in a healthy, well-run business, investment is not determined by how much money you have. It's determined by the return on the investment you're examining. And so the fact that there's, quote, plenty of money doesn't mean you're not going to affect investments. Okay? Now, one thing you might ask yourself is, well, geez, and we heard a lot about SAC. Remember, people talked about SAC yesterday. We talked about SAC today. And I think there's no question that the SAC process needs to be improved in some ways. I mean, it's a difficult process. It's a costly process. And the question is, well, aren't these other alternatives, aren't they a substitute for SAC? Aren't they an alternative way of doing what SAC tries to do? And in many ways, these proposals aren't really a substitute for SAC. And I'll try to go through them and explain why. First of all, SAC has two key economic features to it. First, it tries to look at competition. What rates would competition generate? And in particular, it says if there were no barriers to entry, this was a contestable marketplace where anybody could come in and compete for the business by building the capacity, what would prices have to be? What would be a constraint on prices? That's the nature of the SAC test. It's about a competitive standard. And one thing we've learned in economics is that competition of that type, real world type competition, that is competition that's focused on what would private enterprise and what would private individuals want to do, is a great benchmark, because it gets us away from kind of the tinkering that comes in when you try to be a social planner and decide, well, what would be a better thing to do than what a market would generate? Those are very, very difficult questions to ask. The second thing is SAC focuses on the rates being paid by an individual shipper. They ask, is that shipper paying more or less than what would be that competitive benchmark? Okay. Now, proposals that simply say to get a benefit, you just need to do two things. You need the railroad to be revenue adequate, and you need to establish market dominance, cut out both of those things. They don't ask about what the competitive price would be. They don't ask whether your rates are above or below the competitive levels. And therefore, they're not really substitutes, because they're not trying to establish the same results. Now, you might say, well, aren't they a close approximation? Isn't it really probably an okay assumption? Well, there's two implicit assumptions in those approaches. One is the achievement of revenue adequacy, and the fact that railroads are revenue adequate tells us that somehow they've collected too much from the captive shippers. And secondly, that, and so let's think about that one first. So the fact is, well, what does the data say? Well, the data says that, in fact, over time, and this is what we talked about before, the biggest growth has actually been, if you look at margins, the biggest growth in margins was actually on the exempt traffic, much bigger than it was on the non-exempt traffic. So the fact that railroads have become, as measured by the board, revenue adequate doesn't really tell you that there's been an overcharge to an individual, potentially captive shipper, or even to them as a group. And that's exacerbated by the fact that the vast volume of traffic and the vast amount of dollars is actually from those exempt and otherwise presumed competitive categories of business. Secondly, if you look at the distribution of, for example, just RVC ratios, there's enormous overlap between the presumed competitive traffic and the competitive traffic or exempt traffic and the what you might call potentially captive traffic. There's enormous overlap between those two things, which isn't that surprising. But what it means is establishing that you're somehow potentially market dominant isn't enough to say by himself you're paying too high a rates. It's not a very close correlation between the two. Now, one set of proposals that tries to look at individual rates are the comparables approach, and that was what was talked about in the TRB paper. In principle, the comparables approach is something you could look at. And in fact, I have experience in other industries that use the comparables approach. And one thing I'll tell you based on that, it's not without its own sets of disputes and battles. And the battles get messy, and it's not like, oh, good, we just get from here, there's the answer, and guess what, we're done. Doesn't tend to work that way. There's a lot of problems. Secondly, when you think about it applied to this industry, there's some particular issues. One is the fact that you don't have competition means you're probably not in some fundamental sense comparably situated. That is, there's a reason why you're in a different market structure. You have a different cost to serve, you have different alternatives, there's just so many differences out there. Well, then the answer is, well, can't I correct for those things? Well, but once you start correcting for those things, like Professor Kalt said yesterday, you're sort of pushing yourself back in the SAC direction of, oh, I got to take account of this additional cost because it's a low-density market, and I got to take account of this additional cost for another reason. That really gets you back into almost a SAC-type analysis. So you've saved much less than you thought. Secondly, and I think this also came up yesterday, I want to reiterate it, there are incentive effects that come about when you have comparable regulation. In particular, if I'm a railroad and I'm asking, do I want to give a low rate to this guy over here? Well, you better be careful if that's going to turn out to be the comparable that drives the rates that everybody else looks like they're going to try to get. So you gotta worry about that. Finally, second to last thing I'd like to talk about, and this came up yesterday, is this question about replacement costs. First, I think there's a fair amount of confusion and I don't think it's your fault. I think it's just everybody's talking about different things, and I think it's led to some confusion. What do we mean by replacement costs? Take the example of a 10-year-old locomotive. Moving to replacement cost doesn't mean substituting a brand new locomotive for a 10-year-old locomotive. It means valuing the 10-year-old locomotive at what it would be worth today. That's the opportunity cost of the asset. If you think like an economist, that's what's really the amount that the people have invested. It's what it's worth today, what those assets sell for in the marketplace today. Now, the second critique is that it's really hard to do. Okay, can I have a couple of minutes? It's really hard to do, and the answer is, depends on how you do it. If you do it there's an easy way to do it, a fairly straightforward way to do it. One is, what you do is you do the same thing you do for historical cost calculations. It's just when you take those past investments, the investment that happened 10 years ago, you bring it up to current value using a price index. So what would that same investment cost today? So how much would it cost? And then depreciate it back, reflecting its age. That will give you today's value of a 10-year-old locomotive, for example. So it doesn't require additional data beyond what you need to go in, other than the prices, other than the price index. That's all you need. So if you have your assets divided by categories, you can construct, and Dr. Brenner kind of described that. There was also a discussion about, well, geez, once you do that, don't you have to use a real rate of return? And the answer, again, is no. The way you have to do it is just adjust the depreciation to reflect real depreciation as opposed to the nominal depreciation used in the original calculation. Once again, that's not a separate calculation. Once you've constructed the capital stock series, you have the implied depreciation just automatically. So you can correct the numerator in a way that's going to actually generate a nominal return that can be then compared to the nominal return on capital. So it doesn't necessitate a whole new exercise to estimate real returns. I can put this together for you and describe all that if you're interested. So finally, where does this leave us? Well, I think it leaves us in a point that I would say is important. You can't say that revenue adequacy has eliminated concerns over investment. Using revenue adequacy as a trigger or as an element of a rebate or cap program is going to extend the adverse effects of rate of return type regulation across the company. And because of the fact that people make decisions on a project by project basis, you're going to affect investment even if overall the railroads remain revenue adequate. Thank you.
Just to follow up on your replacement cost example, is that similar to the method that Department of Commerce uses that was being described yesterday in the testimony?
That's essentially what they do. They're
Okay.
basically valuing past investments. They're taking the real value of past investments and depreciating those rather than the nominal value of past investments and depreciating those. And then that gives you your replacement capital stock today, and then the amount of depreciation that you've accumulated in there tells you how much depreciation to put into today to measure today's net return, net of depreciation. And that can be compared to a nominal rate of return.
Thanks. Deb? Ann?
No, I thought everyone's testimony was very helpful and clear.
I have no further questions, so thank you very much. It was very interesting testimony.
You guys got off easy.
Why don't we bring up the final panel, panel number 5?
It's me. We can hope there's no fire drill this time.
Depends how long we
I'm
do.
here on behalf of Samuel J. Nasca, who's the New York State Legislative Director for SMART. Can you file a statement? This one here. Filed a statement on November 4th of last year. It's 4 pages. I'm not going to repeat it. The main thing that the union is concerned about is the differential pricing. Also, I might say that whenever there's a congressional problem involving labor and management situations or a presidential review board, the issue of railroad adequacy always comes up. Can the railroads pay for what you're asking for? So there is an interest in the subject. I thought I might contribute to this by explaining because I haven't heard it here, what the actual situation was and is now with respect to the way revenue adequacy is administered. It is, we all have a book, we got those of us who are practitioners, called Reasonable Freight Rates. And I suggest it's a good handbook to have. It's the type of thing that ordinary practitioners, people like people from Montana have, so you get educated by it. And there's a section in there on how revenue adequacy is dealt with. And generally, it's just a policy situation. It is not something where, in fact, the general rule is that the financial condition of the railroads is of little probative value in determining rate reasonableness. There's an exception, and exception is coal, and even that is in reference to the entire system of railroads in a particular coal field. And it is not to be used in particular line segment reasonableness. And this is the way it's been for years and years, and the book has about 20 cases in it. If you want to look at it, you can see the way it's been administered. And in the past, when the railroads were in trouble, we had ex parte increases. And this agency, or the old ICC, put out a publication, 100 pages, showing all the general rate increase adjustments since Louis Brandeis back in 1914, all the way up to ex parte 267 in 1971. And there's a date, and there's the page references to the ICC reports, and even the tariff publications. And there were rate decreases, but they're always on a general basis. But for individual rates, the condition of the railroad is just not relevant, not used. It's a policy directive, that's all. And it's worked for many, many years, and I suggest that you take a look at it. And I just don't think there's a policy to adopt a policy that's going to use revenue adequacy in individual point-to-point rate adjustments. It has to be for the whole system, or for the whole region, and involving more than one railroad. The other quick subject I'd like to mention is what happened on June 10th in ex parte 665 sub 1. That was your great transportation hearing. All of a sudden we woke up and we came in, and there's the TRB report. Unannounced, presented, given all kinds of press releases to the public. And we've never had an opportunity to go into it. We've never had a hearing on it, but it was actually this agency, or its predecessor, that caused the TRB report. In fact, initially we had ex parte 658, it was instituted 10 years ago. And board member Mulvey gave 6 speeches on it. We've got to have a proceeding. It suggested that the TRB should institute a proceeding. With this prior congressional experience, he asked for a budget request of $1.8 million to hire these professors to go and do a study, basically, of the Staggers Act. But that didn't turn out to be the Staggers Act. It was a general, as we all know what happened, it came out. And a number of us filed comments in ex parte 658, questioning whether this was just going to be another executive branch attack on the STB. And then the government also did that when the ICC existed. There was a rivalry between one branch of government and the other branch of government, and they felt that the ICC was wrong, and the current DOT felt the STB is wrong, and the professors always think it's wrong. And the now retired vice president of the UTU said this in a statement. His name is John Fitzgerald, which we filed in ex parte 658. And it's only about 5 pages, and we predicted what had happened. All of a sudden, we got hit with a big thing, not on grain transportation, but a big attack, and on having a whole new system of giving railroad revenue adequacy. In fact, criticized the STB's handling of rates. So I think it's in order, you might want to think, to allow comments on that TRB study, which is really a DOT finance study, because it's come up in a number of your ex parte cases, including this one. And these economists don't have the last word, and I think they should be, we should have a hearing on that, or at least an opportunity to file comments on it. Because you people, Mr. Mulvey and also Chairman Norber, gave one talk saying, let's have TRB, give a study, give some money. So you were really the major, in fact, Mulvey was a major force in that, getting that budget, $1.8 million to study the Staggered Act. Thank you.
Thank you very much. All right. Thank you, Mr. McDougall. And thank you, everyone, for coming, for your testimony. Thank you, staff, for all your efforts to make this a successful hearing. And the hearing is now adjourned. Thank you.